The elite traders on our desk can often pull a profit from the markets even when they end up wrong on direction. In this video, our head of options trading will teach you how to do this yourself. I'm Mike Bellafiore, and we're one of the long-standing proprietary trading firms located in New York City since 2005, and now Miami as well, and proud to develop numerous consistently profitable traders. Watch, take notes, and learn from our prop firm so you can grow your trading account.
Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And if you're an equity trader, there's one thing for sure, and that is that if you go long a stock and then that stock goes down, or if you go short a stock and then the stock goes up, well, you're going to lose money. And that's just the hard reality of trading. But suppose that there was a style of trading where you can actually be wrong about the direction of the asset you're trading and still make money. Well, believe it or not, there is a trading style that works exactly that way, and that's what we're going to be covering in today's video. So if you'd like to make money, even if you're wrong about the direction of a stock or index, then stick around because I think you're going to find this to be pretty eye-opening. Now, before we get into the options strategy we'll be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy we'll be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so in order to explain to you how this strategy works, we're going to show you an example using index options for the SPX index. And so let's head back to October 4th of last year, 2024. And as you can see, the SPX index had been rallying all year very aggressively, up over 20% for the year at that point. Although you'll notice that starting on September 19th, for that 2-week period leading up to October 4th, the index had actually traded in a very tight range, 5,700 to 5,750, closing right at the top of that range on October 4th at 5,751. And so let's say that on that day, you had formed the opinion that the market was going to press higher for the rest of the year after this 2-week consolidation. And so suppose that on that day, you pulled up an options chain expiring a month later on November 4th, and you went ahead and sold one of those 5,700 puts for which you were paid a price of $65.20, and simultaneously you bought a 5,600 put 100 points lower down on the options chain, and you paid a price of $44.15 for that one. Well, when you do that, selling a put higher up on an options chain and buying a put lower down on that same options chain, when you do that, then you are selling what options traders refer to as a put credit spread. And since the put credit spread we're selling is 50 points lower than where the index is trading, we are technically entering into what is known as an out of the money put credit spread, because both the short and long options in this strategy are below where the market's trading currently. To understand why we did this, let's first take a look at the cash flow of the trade. And so starting with the 5,700 put that we sold, well, we received a price of $65.20 for that. But remember, index options pay off at a rate of $100 for each point that the index closes below the put's strike price. So you multiply that by 100, and so you were paid $6,520 for selling that put. But at the same time, for protection, you bought the 5,600 put for a price of $44.15, which, using that same kind of calculation, means that you paid $4,415 for that put, resulting in net positive cash flow of $2,105 flowing right into your account at that point. And if you did this, you'd immediately notice that your account cash balance had increased by $2,105 at the outset of the trade. Now, it's also important to remember that there's risk in this trade because you sold that put, so you're on the hook for paying $100 per point if you were really wrong, and the index closed below 5,700 on November 4th. And so your broker is going to require you to have at least $7,895 in your account to make sure that you have the funds in your account to honor your obligations if need be. What's going on here exactly? Well, let's think about it. The premise of the trade was that the index was poised to break out to the upside from the range it was trading in during the previous 2 weeks. Well, if the index did what we anticipated and it closed higher than today's closing price of 57.5107, then obviously both puts, which are located lower at 5,700 and 5,600, both of those would expire worthless because puts only pay off if the index closes below their strike prices. Instead, those puts would simply expire with no value, and so you win. Why do you win? Because remember, you got that initial $2,105 when you first started the trade. Well, now with both puts having expired with no value, then those puts just die and go to options heaven without ever having to pay off at all. And so you just keep the cash flow you received and you win the trade with a profit of exactly that cash flow, $2,105. Okay, simple enough to understand. So let's now move to the day that this trade expired, which was November 4th, 2024. And as you can see from this price chart, the index initially rallied, it then sold off. And so by November 4th, it had actually fallen below the price the index was trading at on the day we entered the trade. And it closed at 57.1269, about 39 points below where the index was trading on the day we entered the trade. And so our premise was wrong in that we expected the market to rally by November 4th, when in fact it sold off, ultimately by that date. Now, when an options trade expires, the individual options comprising that trade can be assigned a value. And so let's examine that, because we can't know how our trade came out unless we assign a final value to each of the options. And so starting with the original cash flow that we received, the 2,105 that we got when we first entered the trade, we'll then look at the closing value of the 5,700 put. And since it expired more than 12 points below the index's closing price that day, it expires worthless with a value of 0, and obviously so does the option below that, the 5,600 long put we bought for protection. And so since neither of them have any value, then we just get to pocket the $2,105 in profit that we collected at the outset of the trade as our trade profit, a return of 26.6% in a month on the required capital. Now, as you'll recall, the premise of today's video was to share with you a trading strategy where you'll have an initial premise, and that premise turns out to be flat out wrong, as happened in this case, but you still had a full profit victory on the trade because you have a little knowledge of how option selling strategies work. We thought the SPX was going to be trading at a higher price a month later, but in fact it was trading at a lower price, and we still won. Why? Because with out of the money put credit spreads, the goal is to collect premium and have the put options expire worthless at the end of the trade, because in that case, we can just walk away with that nice initial cash flow. And so obviously the easiest way for that to happen is if the index were to have rallied. But the beauty of out of the money put credit spreads is that even if the index sells off, as long as it doesn't sell off down to below where the short put is located, we will win the entire cash flow of the trade. And so if you feel good about your premise, but you want to leave yourself some room to be wrong, then just locate the short put at a decent distance from where the index is trading, and you'll give yourself some wiggle room in the trade. That way, if your premise wasn't exactly correct, you will still have a solid chance to win the trade. And that's the beauty of options income trading. You can set the trades up to give you a way to win in many different scenarios, not just the scenario that you predicted. And as we saw vividly in today's example, that's exactly what happened. With options income strategies, you can win trades in lots of different ways and with lots of different outcomes, which is why this options trading style is so compelling to professional traders like us here at SMB Capital.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.